Just what's your take on US and European monetary policy at the moment?
US and European monetary policy, well, I think it's a disaster. I mean, this is something that has built up for quite some time, but to be at the zero bound on interest rates at this stage of the, if you can call it an economic cycle, it is really awful. We really don't have anywhere to go. I mean, we have to wind back a long way to see how we got here, and maybe there's not enough room in this interview for that. But I think the sort of what we could deal with at the moment is looking at US monetary policy. Is that we have interest rates at zero bound, and we have had what I've run out of time. We've had QE3 and Operation Twist. So we've had various sort of iterations of quantitative easing where money has been printed, pumped into the economy. And where has it got us? Well, actually not very far. I mean, you can say, well, okay, the counterfactual, where would we be if we hadn't had that? I don't know, but where would we be if we'd actually let some of the banks go bust? I don't know again. But it just seems to me that I can't actually see a time when the US will ever pull back from some type of monetary stimulus. And if you look at sort of how asset prices, if you look at the S&P, look at bond yields, but the S&P in particular, you can see that actually as soon as any time the Fed tries to pull away from quantitative easing, we get a sell-off in stocks. And for some reason the Fed seems to think that, well, the Fed seems to think that a rising stock market is all important, and it don't dare let the stock market fall or correct for whatever reason. Now, you could make sort of the explanation could be that could be sort of for numerous reasons. Ultimately, the Fed like to talk about the wealth effect, but actually there are so few people in the States who actually benefit from this wealth effect. You've got to think that it's actually sort of only a very, very, that small number, the 1% or whatever, who are really benefiting, who are really going to be benefiting from keeping the stock market at elevated levels. You can argue that about pension funds or whatever, but, you know, it could be a remarkably small number. And anyway, why shouldn't markets do what they're supposed to do? Why shouldn't markets flush out the rubbish? You know, let's talk, you know, Schumpeter's creative destruction. Let's get rid of the rubbish and start again. Let's not have zombie companies who are sort of absolutely, you know, buried by debt that shouldn't be in business but are being kept in business by zero interest rates or very, very low interest rates. You know, savers are being crucified here. You know, this is all the wrong way round. And so I think the monetary policy is a complete and utter mess, and it'll go on being a complete and utter mess, because I just don't see any reason, any way that the Fed is going to back away from quantitative easing. I think there'll be more and more versions of it every time the stock market has a wobble, unless you see real wage growth in the States. And there's no sign of any wage growth in the States. It's just not there, and it's not going to be there because although unemployment has been falling, which is great, the participation rate is falling also. And so there's so many US workers who are now non-workers who've just dropped out of the system completely. There are so many millions on food stamps. You know, the situation really is quite dire out there. And it's not good over here. It's not good in Europe either. And we're also interconnected now that, you know, we do rely on each other. And in some ways, you've got to think, well, actually the States is possibly in a better, and this is why I think actually the US dollar is probably going to triumph over other currencies in the long term. You know, the US is what, 22% of world GDP, roughly, and I think its exports are something like 12%, something like that, 12% of GDP. Well, Germany, which is, I don't know what it is, I think it's 6-7% of GDP, and its exports are 50% of that, or 51% of that. Now, I mean, those are sort of two examples. I'm just sort of trying to put it into perspective of sort of how much Germany relies on, you know, export markets in Europe and elsewhere, and the US doesn't to such an extent. So, you know, what I'm just sort of trying to say is that we're all interconnected, we're all trading with each other, but, you know, in some respects, the US, despite its terrible monetary policy and despite its terrible sort of governance, is perhaps because of its, you know, because of its demographics, because of its resources, in a much better position than perhaps we are in Europe, where you've got the, you know, the main economy, the main driver of Europe, so reliant on exports. And you know, the only thing it's got going for it at the moment is it's lucky that everyone, you know, all of its customers are still in a currency union, so they can, they've actually got a currency where they can avoid, they can buy stuff, because otherwise they wouldn't be able to.